SBEV or Splash Beverage Group. This is, without a doubt, one of the most volatile and, frankly, most debated microcap CPG stocks we've looked at in a while. The company is at an absolutely definitive crossroad. I mean, it's defined by this huge recent governance upheaval. The real debate here, the core question, is whether this new leadership and their very aggressive strategic pivot can actually pull off a distressed turnaround. Or are the liquidity risks and the just brutal history of shareholder dilution simply too much to overcome? I'm going to argue that the changes we're seeing justify, well, a cautious optimism.
And I think we have to start this whole conversation grounded in the cold, hard financial reality of the situation. We can't just analyze future strategy in a vacuum. I mean, the entire foundation of the bear case is the auditor's explicit going concern warning. Look, when a company with national distribution deals reports a cash position of around $265,000, you're not really discussing strategy anymore. You're discussing whether the lights will be on next month. Imminent insolvency. The structural fragility and that disastrous history of dilution are, in my view, far too significant to be waved away by a hopeful pivot.
I understand why you're zeroing in on that liquidity crunch, but I would argue the current market cap is completely disconnected from the intrinsic value because the market is only pricing in that immediate risk. It's ignoring the strategic solution the board just put on the table. The key here, the real turning point, is the installation of William Capel as the new chairman. This isn't just shuffling names on a letterhead. Capel is a specialist in corporate finance and M&A. I mean, this is the guy famous for orchestrating huge deals, like the $1.8 billion tailor-made golf acquisition. His presence signals a board-mandated shift towards strategic alternatives, a sale, a merger. And that kind of action typically commands a premium well above these depressed prices. That's an interesting point, though I would frame it differently. The management change isn't just a sign of distress. It's a necessary restructuring specifically designed to secure an exit before the cash runs out completely.
Necessary restructuring, sure, but it often comes far, far too late, especially when the balance sheet is already, fatally wounded. Let's just look at the numbers. Q3 2025, a net loss of $4.6 million. You're holding less than $300,000 in cash. We're talking about a burn rate that just incinerates the company's entire available capital every few weeks. This forces them into survival financing, and that leads to the most toxic part of this whole story, the high-cost capital they're leaning on. They just raised $500,000 through senior promissory notes, but these notes, they came with a 15% original issue discount, or OID.
And the OID is certainly punitive, I'll grant you that.
It's way more than punitive. It's a sign of pure desperation. A 15% OID means SBEV only got $425,000 in cash, but they owe the lender the full $500,000 plus interest when the notes mature in 2026, which is, just around the corner. That effective interest rate is exorbitant. It guarantees that any potential future revenue is just going to be immediately siphoned off to these, let's be honest, predatory debt holders. And on top of that, you have the concurrent immediate departure of both the founder CEO, Robert Nistico, and the CFO, William Devereaux. That creates a massive knowledge vacuum at the worst possible moment. So I'm sorry, but I just don't buy that the new strategy is viable. The brand portfolio has zero value if the company goes dark next quarter.
The liquidity issue is paramount. There's no argument there. But let's dig a little deeper into that leadership change, because I think the dual exit, when you look at it through the M&A lens, actually supports my thesis.
Okay, let's analyze the optics then, because I have to challenge you on the implications of the CFO and CEO leaving right alongside that going concern warning. In forensic accounting, the simultaneous exit of your top two leaders, financial and operational, is a critical red flag. It strongly suggests either deep disagreements about funding or maybe just sheer executive fatigue from trying to manage a company that's perpetually on the brink. This doesn't look like a clean transition for growth. It looks like the executive team is jumping ship.
I get the skepticism. I do. But the context of what the new board did immediately after is key. By installing Capel, a professional M&A guy, whose whole reputation is built on selling and restructuring assets as chairman, The board is basically confirming they are prioritizing an exit. They're signaling to the market and to potential buyers that SBEV is officially in play. And what's more, we have concrete evidence that insiders believe in this path. Just look at the cluster of insider buying in November 2025. The company's secretary, Radha Namadian, bought almost 20,000 shares. Other execs bought in too.
Hang on, let's unpack that insider buying for a second. You call it high conviction, but we have to ask, high conviction in what? Is it a belief that the company is suddenly going to turn a profit? Or is it just positioning for a short-term financing bounce that lets them flip the shares in 48 hours? I mean, we need to look at the actual dollar amount versus the debt before we call it high conviction.
It is high conviction because they are putting their own personal capital on the line directly against a known going concern risk. They know how bad the financials are better than any of us, and they are still buying. They're making a bet on Capel's ability to secure a favorable outcome, whether that's a sale of assets or landing a lifeline that wipes out that short-term debt.
I come at it from a different way. You have to acknowledge the insider buying, okay? But you also have to reconcile it with the just devastating historical cost to common shareholders. We can't ignore the cumulative dilution that defines this stock. An investor who bought, say, 120 shares back in 2021 now holds exactly 1 share after the 1-for-40 reverse split in March 2025. That is a virtual wipeout, over 99%. So insider buying, even if it's substantial, doesn't erase that structural problem. The company's survival has always been paid for, brutally, by the common shareholder. Why is this time any different?
Because the historical failure, that legacy portfolio that just couldn't scale profitably, that's precisely what this operational pivot is designed to fix. Let's talk about the actual operational lifelines, because if they execute, even partially, the whole picture shifts. I defend the pivot as viable, especially the $6 million annual Costa Rica water contract. It's supposed to start in Q1 2026. This is a real, verifiable financial lifeline. I mean, a contract that triples your top line. That's the kind of thing that justifies bridge financing.
A $6 million contract. Sounds amazing, I agree, but this is where execution risk comes in. How does a company with $265,000 in cash that's struggling with high-interest debt realistically fund the supply chain and logistics and everything else needed to fulfill a $6 million contract that starts next quarter? That revenue number assumes flawless execution and a lot of upfront working capital that SBEV just doesn't have. If they can't get the financing to ramp up, that contract is just a piece of paper.
Well, they're using the contract's future revenue as collateral to get the financing capital is there to find. It's a classic turnaround play. You secure the future revenue, then you use that to get the funding you need today. And on top of that, the Chispo Tequila anchor customer deal is a much smarter strategy. Securing a house pour deal with a big national restaurant chain, that's the gold standard. It completely bypasses the slow, expensive retail model that crippled their other brands. They're going straight for high volume.
I have to question the visibility there, because the identity of that restaurant chain is anonymous in the filings. That lack of transparency is a huge risk factor. And more critically, the value of their legacy brands is eroding and fast. Take Form Energy. SBEV had this whole speculative thesis built around its celebrity associations. Well, that's been directly undermined. UFC President Dana White, who is tied to their Top Hoop brand, is now partnering with Anheuser-Busch InBev to launch a competing drink. That just shows you the big players are winning.
I'm not convinced by that line of reasoning because the market is already pricing in zero growth for that legacy portfolio. The fact that Tapuchi is being eroded is exactly why the pivot to Chispo, to the water contract, to the new THC venture is so necessary. It's the only way forward. The value here rests entirely on these new, higher-margin ventures. The old brands become irrelevant if Casable can bundle and sell these new growth assets to a major competitor.
But if we shift back to the market microstructure for a moment, that going concern warning is like an institutional poison pill. It keeps 90% of traditional funds from touching this stock. So SBEV has to rely on retail traders and, more importantly, on those predatory lenders. That just structurally increases volatility and risk, no matter what they do operationally.
The volatility is a real concern, absolutely. But is the structure itself entirely rigged against the shareholder?
I'd say yes, because of how the market mechanics work here. Let's talk about dark pool activity. On November 12th, over 54% of the off-exchange volume was reported short. Now, this isn't necessarily a massive institutional bear rate. It's often market makers shorting to meet retail buy orders, which caps the price, and then they cover later. It creates a natural cap on any rally, stopping the stock from moving up even on good news.
Okay, I acknowledge the high dark pool volume. It's persistent, but we have to separate that from open short interest. The official short interest is only about 7.5% of the float, with a really low days to cover of 1.9. This tells me the stock isn't fundamentally doomed by some overwhelming short position. The volatility, I think, is more a function of the incredibly low float, about 1.9 million shares, and that low float cuts both ways. Yes, downside is high, but it also allows for explosive upside on big news from cable, because there are so few shares to go around.
That's a compelling argument, but have you considered the history? The history of reverse stock splits is the ultimate sign of structural decay, a 1-for-40 split in 2025 after a 1-for-3 in 2021. This shows a clear destructive pattern. The whole mechanism just crushes long-term holders, regardless of the short interest today. The constant need for capital financed by instruments to just ratchet up the dilution. The only certainty here is that existing equity value will continue to erode.
And I maintain that the current valuation provides a significant margin of safety if even one of these catalysts hits. Cable's M&A expertise, that $6 million water contract, the Chispo anchor customer, they create a clear, even if it's narrow, path to a favorable exit. The insider buying confirms this conviction. The market is just focused on the cash runway and ignoring the assets. It's a high-risk bet on a strategic solution, no doubt about it.
And I will reiterate the fundamental issue: solvency. The huge gap between the $4.6 million quarterly loss and the tiny cash runway means the company depends on absolutely flawless execution in Q1 2026. And the extreme dilution and the high-cost financing, it all implies that any benefit from a turnaround will flow first to the debt holders. Common equity is at the very bottom of the capital structure, and the deck is really stacked against them.
So we both agree then that the decision point is Q1 2026. Anyone watching this needs to monitor those three catalysts: the funding and delivery of the water contract, the naming of the Chispo anchor customer, and a long-term capital solution that gets rid of those toxic notes.
Absolutely. The stock remains defined by extreme volatility and fragility. The outcome is highly uncertain, but the risks are quantified and very, very extreme. Concluding production script, Splash Beverage Group is in severe financial distress, highlighted by a critical cash position and a going concern warning. However, the appointment of M&A specialist Bill Capel, the potential $6 million annual water contract, and substantial insider buying provide counter-arguments that suggest a strategic turnaround or sale is imminent. The primary tension remains between the strategic optimism and the structural risks posed by high-cost financing, severe historical dilution, and rapid cash burn. Final production script. Thank you very much for hearing us. Let us know in the comments what is your opinion, and if you want us to analyze other stocks, don't forget to subscribe to the Stock Market Palantir channel to catch up with more stock insights, and see you in the next video.